We had a $500 million of cash, and we saw interest rates at zero. And we saw the stock market inflated in the summer of 2020. And we said, well, what are we going to invest in? And we looked around at everything. Should I buy gold? Should I buy land? Should I buy art? Should I buy some crypto asset? And what's going to happen next? So what we did is we decided to buy Bitcoin, and we bought $250 million of Bitcoin August 10th, 2020. And then around September 10th or so of 2020, we bought another $175 million of Bitcoin or something like that. And then we started buying Bitcoin more in December, and we kept buying Bitcoin. We ended up buying nearly $4 billion, $3.97 billion of Bitcoin over that time period. So in terms of like our strategy, MicroStrategy has just bought as much Bitcoin as we could get our hands on since August 10th of 2020. If it's in a row, I take $70 billion from you. But the question is, what are you going to do? You're going to put it in gold. If you have $1 billion, what are you going to put it in? Well, the Russians put it in gold. We just seized the gold. You're going to buy a yacht with it? I mean, we make the yacht. You're going to buy land with it? Whose land? Land in another country? I already land in my own country, right? So the U.S. primary export nation, monetary technology in the form of the U.S. And what we trade for is we get energy or we get products or services in return for exporting the dollar. Right now we're on this cusp because we're exporting too many dollars. And collapse of other countries' currencies. And when their currencies collapse, their governments collapse. So the U.S. won't collapse. What the U.S. provides, financial, economic security. Like, for example, if you live in Mexico or you live in Argentina and you've got $1 million, are you going to save it in the peso? You're going to save it in the dollar, right? How are you going to save your money? If you export $100 billion of oil from the Middle East and we give you back $100 billion in dollars, what are you going to do with the $100 billion? You buy T-bills with it. So you buy sovereign debt that yields 2% interest. And so now if you hold $100 billion worth of sovereign debt, now if I double the money supply, it's worth half that much, right? So in essence, if I'm increasing the supply of dollars by 7% a year, and if you're holding $100 billion of my debt, then you're paying $7 billion a year to hold the debt. So I'm charging you $7 billion for the privilege of giving you a bank to put your $100 billion in. It's a negative interest rate, right? Negative real yield. The first countries to collapse will be Zimbabwe, Lebanon, Syria, Iraq, Iran, right? Not Iran, but Afghanistan, Iraq, South America, all throughout. They're all being destabilized, Sri Lanka. So what you have is this rippling wave of destabilizations in the developing world. You have a weakening in the developed world. As their currencies weaken, they're going to suffer from inflation. If we have inflation that's 8% in the US dollar, if we look at the past year, what you've got is a drawdown of all financial assets. So the NASDAQ is down about 22% over the past year. And so NASDAQ represents tech companies and all the risk assets. But on the other hand, if you were to go and look at like the bond market and the bond portfolios, bonds are down, like the BOND index, the long bond index, it's down almost 17% in the year. I think what happened here is the Fed just pumped tons and tons of liquidity, and we stayed high for about a year and a half. And I remember when Jerome Powell said, I'm not even thinking about raising interest rates. And said strongly that it'll be till 2024 before interest rates start coming up again. But here we are in 2022, and now instead of raising them a quarter point, each time, now they're raising them 75 basis points. So they're taking 3 steps at a time, multiple times. So we took the cost of money down faster than any time in history, and now we're jacking up the cost of money faster than any time in history. And the result is that all the traditional models are broken. Let me give you a 2-year post-mortem since we started dealing with this issue. The government is suppressing the free market. So if the government keeps suppressing the free market everywhere, what you do is you cripple production, right? Yeah, that's what we have tariffs on Chinese imports, right? That drive up prices up or down, drives them up, right? You have a war or a labor war, right? If everybody unionizes and if everybody's afraid to go to work and if everybody thinks that their life is threatened to stand next to another human being, right? And if we're afraid to trade with each other and if we're afraid to talk with each other, right? If you have capital controls, wage controls, price controls, export controls, manufacturing controls, if the economy measured in nominal terms is flat, that meant that the overall economic output decreased by 20%. The overall economic output decreased by 20% or more in the last 2 years. GDP measured in nominal terms is a gross distortion, and then CPI is a gross distortion. If I have 100 things that you want, and I pick 10 of them, and I measure the increase in the price of 10, and I ignore the price in the other 90, I can show you a CPI is 8%, right? 8.3% is the number this morning. But the actual inflation rate is higher, but it's inflation on something, like it's inflation on something you want, but I don't choose to measure it because we don't actually calculate CPI that way. I take a survey and I ask you whether or not you think you could raise your rent by something. And if the owner equivalent rent is up 3%, then I say that the inflation is 3 or 5. So we have a set of metrics that are just manufactured metrics, and then we focus on them and then we talk about them. But ultimately, what you have is an economy that's distorted. There are some things we produce more of, and there are some things we produce less of, and we have flexibility with what we choose to measure. The monetary intervention is the government basically, if I put everybody under home arrest for a year, it's going to be a problem for the economy, right? I mean, if I shut down, they did it in New Zealand, they did it in Australia, they did it in Canada, they kind of did it in certain states in the US. If I do that, that cripples the economy. So while I'm doing that, then if I go ahead and I pump a lot of money in the system, right, then maybe I create a wealth effect and I can say, well, we're recovering. But ultimately, you never recover from the fact that nobody went to school for a year and nobody, went to work for a year, right? You've lost that forever. You're just not measuring it. You can change your metrics, right? There's a saying, right? The winners write the history books. So the Romans remember the Carthaginians as being like evil, right? If we win the war, then we write out all of the good that our adversary did, and we write up all the good that we did, and we suppress all the bad that we did because we won the war. We write the history books, and so I think right now what you see in the economy is lots of distortion of numbers. Lots of distortion of metrics, right? The fact that we have a debate over whether we are in a recession or not is kind of laughable, right? Because we've been in a recession for 24 months. If you were measuring the production of goods and services, inflation is such a charged term because most people think inflation is CPI. The defect in fiat currencies is monetary inflation. It's the expansion in the money supply, not just the increase in consumer goods, because the CPI is it's a sub-metric, right? If you look at the US dollar, the supply of dollars has been increasing 7% a year for 90 years. It's been increasing 15 to 20% a year for the past 2 years. Whoa. Right. So the big idea. I think
that's true. So it seems walk us through where do you get that number?
Well, if you go back to 1930, my house in Miami Beach cost $100,000. And if you roll the clock forward to 2012, it cost $14 million. And today it would cost you $40 million. So it's 400 times more expensive than it was, 92 years ago. Now, if you back solve that, you'll find that that works out to about a 6% or 7% annualized inflation rate.